Welcome, everybody. I'm Kamil Sarji, your host of Just 2 Minutes, and today we have Jeremie here. Jeremie, you want to tell us about yourself?
Yes, my name's Jeremie Whitland, president of my company, Benefit Mortgage Inc. I'm a commercial mortgage broker and business loan broker operating in 50 states and internationally as well.
Awesome. I'm very excited to talk about commercial lending, but very specific things that I want to cover today. But first, as you know, this show is called Just 2 Minutes. So I have my timer here. Are you ready for the questions?
Fire them at me.
Okay. And go. So if you had like a swimming race between a giraffe and an ostrich, 10-foot distance, who do you think would win?
I would think the ostrich. Shorter legs, faster acceleration.
Okay,
I think they'd be able to make it quicker.
Okay.
I know they're pretty fast. But
What if it was 10 meters?
10 meters? I'd probably still say the ostrich.
Okay, cool.
Yeah.
Now, I remember in middle school having lunch. It's like, you never forget that. What was your favorite lunch dish from the menu?
I always liked when they did some kind of Mexican theme. So I grew up in Florida. So we always had, there's Pizza Fridays. Of course, every school has that. And, if you ask my daughter, she'd probably tell you that. But I always liked when they had like tacos or something. It was just something to change up at the school. They always had the hamburgers and, kind of basic stuff. But something give a little bit more spice, some more flavor to it. So that would be mine.
So Florida had Taco Fridays instead of...
Oh, we still have Pizza Friday, but they could do like Mexican pizza, It was like, it's like instead of like going to Taco Bell almost.
I love it.
So,
have you ever won a limbo championship?
A limbo championship? I would say no. Bad limbo.
Have you ever done limbo?
I've done limbo.
Yeah?
I've done limbo.
Where did you do that?
Oh, it was like birthday parties and stuff like that, but not professionally, nothing like that. But tennis I did in school. And that I did pretty well. But
okay, how do you solve these problems? Quick.
Okay.
Flat tire.
Get the repair kit, pull out the nail, and plug in there.
Fridge broken.
Call the repair guy, appliance repairman.
Oh, awesome. What do you think of those questions?
That's good. Had me think of my feet really quick. It's like Spitfire them out. So.
Oh, man. The amount of
like
weird questions I've asked in the last... This is 45 episodes.
The ostrich one was really interesting. You had me think about that one. I'm like, it's like giraffe can do it. I was like, I think if you asked me like a football field, I would probably say the giraffe would be able to do it at that point. But
you throw water, now it's like...
Yeah, exactly.
So yeah, Jeremie, so you help people get loans, commercial loans. Now, what I want to focus on today, let's talk about, as a real estate agent, we're working with different clients who have different businesses, who need different types of properties, commercial properties. How much do they have to put down in order to buy this building stuff?
So it's a broad question because really depends what the business owner's looking for specifically, and it also depends what type of financing they're going for. Those of you that are familiar with commercial real estate, a lot of lenders talk about SBA lending, and that's still, just like for residential, FHA is very big for first-time home buyers and stuff, helps them get the lower down payment. And that's kind of one of the biggest attractions to going an SBA loan because of the lower down payment. But there's still a lot of little caveats to that. One being if a property is a unique property. So we say, okay, well, how do I know if my property is unique or not? Let's say, well, a unique property is usually defined as a property that's not easily converted or not easily usable by another type of business. So you think of one being a gas station, right? Gas station, what do you think? It has a small convenience store, has the giant roof hood for all the pumps and everything. You have maybe underground storage tanks for the gas or the diesel. And if that business was to close, how easy would it be for, let's say, a guy that has a HVAC/plumbing shop? How easy would it be for them to take over that location? Well, probably not that easy because there's all that demo work that has to get done. So probably the best use would be another gas station to go in there.
But if they wanted that one that needed work, actually, first, let's talk about the different types of loans because this episode specifically is for the occupant, the business owner buying a building.
Correct.
So let's talk about the different types of loans. So we have SBA, you mentioned.
Yeah.
What else?
So you have non-SBA, or what we consider conventional commercial mortgages.
Wow.
So
there's a conventional.
Yeah, it's just kind of a standard.
Do you have an FHA commercial mortgage?
No, they'll be more like your SBA guarantees. So they're all commercial mortgages by banks or credit unions or non-bank lenders that they all can do commercial mortgages. They keep it on their balance sheet. The only difference is, do they have a guarantee from the government, which is SBA. So you'll have the non-SBA guaranteed mortgages. And getting back to your question, that was, typically business owners can get into those properties with about 20% down on the building. So you have $1 million building, you put your 20% down, and you can buy it with a traditional commercial mortgage. And then if you're going like SBA, you can typically get that lowered to about 10% down for the business owner.
Cool.
To move into there.
Okay, so why wouldn't everybody just do SBA loan?
Well, there's differences. Sometimes for SBA, you do have, they just reinstituted for their 7A program, which is a specific type of SBA program. They started back their guarantee fees.
Hold on one second. There's different types of SBA loans for commercial, for business owners purchasing. Okay.
Yeah.
What are those two?
So the two is the 7A program. And that program is kind of like the general workhorse program for SBA, because it can be used for business loans, it can be used for business lines of credit, and it can also be used for real estate. And that's the premier program that a lot of non-bank SBA lenders will utilize, because those are the ones that pretty much get sold off to the secondary market, that banks can sell off those loans. Conversely, there's another program called the 504 program, and that's a loan that's done between CDC, or a Community Development Corporation, which is usually a nonprofit organization that partners with your bank to offer you only commercial real estate mortgages. That's all the 504 program can do. Mm-hmm. The nice thing about that program is, typically the non-profit organization will give you a lower interest rate, and the bank is still going to give you their normal interest rate, which is a bit higher. And so when you combine the two loans, you get a little bit of a smaller interest rate, a lower interest rate, because one's giving you lower, one's kind of giving you the normal. You blend it together, and you'll get a little bit of a break on your interest rate, which is nice.
Are there types of buildings or commercial properties that they don't want to loan to?
Well, there's always going to be properties that are going to be undesirable to different types of lenders, right? It's like the beauty's in the eye of the beholder. So Bank A may like, gas stations and gyms and retail and medical offices. But then Bank B may say, oh, we don't like gyms, but we'll do office space and we'll do retail spaces. And then Bank C may say, you know what? We only like industrial and warehouses and medical space, but we don't like retail. We don't like gas stations. So everyone has their own preference.
They got to stop with that.
Well, it's commercial. So commercial is, I tell everybody, commercial can be very beneficial, but commercial lending is like a double-edged blade. The great thing is a lot about relationships with lenders. And that can help you quite a bit, and that's why a lot of people come, seek my guidance and help to put together the loans, because I can help guide them through the process for these lenders. But at the same time, a lender can discriminate and say, well, I don't like these type of buildings. I don't like this, industry. So if you remember during COVID, what was one of the big industries that got really hit? It was gyms. Gyms took a huge whack during COVID. And every lender says, nope, don't bring us a gym. We don't want to hear that word. We're not touching it. And it was like that for a number of years. I mean, that industry took a huge hit. There's a lot of lenders that don't like restaurants because of the high default rates and failure rates of restaurants.
Huge failure rate, yeah.
So there's certain industries. And, really good thing for the audience is you can actually look at the default rate on the SBA's website and see what's the default rates for all the SBA loans by all the different business industries and all the different categories.
So if you want to start a business, you're like, I want to start a business. What's more successful? What's a better opportunity? You look through that list, the default list on the SBA site.
Yeah.
And you're like, oh, wow.
Yeah.
This has the least amount of failure rates.
Correct. So it gives you an idea. And this is something, too, that lenders look at because it's typically going to represent in their portfolio kind of, let's say they're exposed to, when you buy a stock or something, you get like a mutual fund. It has a little bit of everything from the stock market. Well, the same thing's like a lender. They invest in a lot of different properties. Like, we're here in New England. So, we have a lender that maybe does Connecticut, Massachusetts, and Rhode Island, and they'll have a diverse portfolio of commercial properties that they've loaned money on, and they'll know, which ones are performing well, which ones are teetering, and which ones are failing. And so that's where they'll adjust their credit policies and, make that determination of what industries do we want to lend to and which ones we don't. So
compared to like residential loan where you can't discriminate, this one you can discriminate.
Mm-hmm. Yep. Absolutely.
Goodness.
So that's why I said it's a double-edged sword. There's a lot of different ways that we can structure loans. So like one of the nice things that we can do in commercial for business, I have one of my clients took over a medical office space and she did seller's note with the seller instead of getting a traditional commercial mortgage. And she's going back to the bank to get a construction loan to help finish her medical office space. So, and that's allowed in commercial, whereas residential, typically they won't really allow that. So there's a lot of different ways that we can structure deals to help a business owner be able to acquire that business for their company.
And a lot of times they're not thinking about it, but they're like, yeah, my business would be great in here. I would love to buy this. And they buy it and they're like, oh my gosh, we need to fill this up with equipment that we use to do our business.
Yep.
What happens in those situations?
So that's kind of the other side of my business that comes into play because I do help business owners obtain business loans and equipment loans and things like that. So, we may have a client that says, oh, I want to, buy this building, but it's going to be bigger than my current location. Let's say take a mechanic, for example, and maybe they have a 1-car lift in their current space, but they're going to go to this new space and they can fit 3 lifts and increase capacity to take on more clients.
Wow.
That's something that we can do. We can help them get a construction mortgage to buy the property and put in additional lifts because they'll be permanently, they're bolted into the ground.
So it would be 2 separate, because construction to build the thing.
Yeah.
And then the paying for the equipment to buy the lifts.
Correct.
It's 2 separate loans and actually 3, like the building, construction, and the equipment.
Yeah, and we can pair the purchase of the building with the construction. We could do that in one. So let's say the building is $800,000, but then they need $200,000 in construction. We could do a $1 million purchase construction mortgage where the $800,000 would go to buy the building, and then we'll hold in reserve the $200,000 for them to go and do that construction to get it ready to put in those lifts. And then they can then get a business loan or an equipment loan to purchase the lifts, have them delivered, and then start installing them. And then we can use the construction funds to install them and get them operational.
So from the SBA 7A and the 504, is that part of SBA or?
That is. So that's the 2 programs. So you have the 7A, which can be used for the business loans, lines of credit, equipment loans, and the real estate. Or you can do the 504 program, which is just the commercial real estate.
Okay. So that's the difference between both of them.
Yeah, exactly.
Are they both like 10% down each?
Yep, exactly. So both for the real estate side, they're the same program for the down payment purpose. The main difference is that with the 7A, it's just you and your bank working together. You're submitting documents to the bank for the 7A program. The 504, you have double the amount of work because you have to submit paperwork to the bank and then to the Community Development Corporation or the CDC. And then both of them have to agree, yes, we want to give the loan to the business owner.
Okay.
But in exchange for that, you're going to get a better interest rate for your loan. And your rate will be fixed as well for the life of your loan. That's a huge benefit of the 504 program is your interest rate is fixed for the life of the loan, whereas the 7A program, it isn't. So
okay.
That's another difference with it.
But with the 504, if you're buying real estate, that's the way to go compared to a conventional commercial.
Yeah, I mean, there's no wrong way for it. There is fees with the SBA program. So let's say you're just looking for the lowest cost. You don't care about down payment. You don't really care about, locking in the rate for the whole time. A regular commercial mortgage without the SBA is a valid way to do it.
Rates are okay too?
They're about this. Yeah, I mean, they'll be slightly higher than the 504, but they'll be probably slightly lower than the 7A program.
And they're probably not dumb. They want to make sure it's variable.
Yeah.
Right? Because it's going to be a long time. And
yeah, I mean, typically 5 years is the fixed rate period on commercial mortgages. And then they'll reset every 5 years thereafterwards. So they'll change a bit. But no, I mean, I had one client, talking about the business loans where, and this could be something to help out clients and stuff that maybe are like, oh, well, Jeremy, I want to buy this property, but maybe I could come up with the 10%, but I'm a little tight, because I still need to pay closing costs and I need to, there's going to be stuff I need to get done once I move into the new property. And that's where the business lending can come into play. Because I had one client two clients were a little short, but they had a great opportunity to buy the building they were going to move into. And what we helped them with is get them a business loan for 5 years. We gave them like $100,000. And that gave them the cushion to be able to use those funds to be able to put as a down payment on their building and still have money for operations and everything to keep running it as they have that, that transition period as they're moving into their new location.
How do you dictate how much they could get?
So there's many different programs for business lending. Typically, we like to see the most recent year of tax returns. So 2024 tax returns are due now for corporate, and then April 15th will be for if somebody's a sole proprietor and they put their business taxes on their personal tax return. So typically we'll look at that. But generally we like to see is what is their net income after, they pay all their expenses and everything. And so let's say we had a business making $500,000 a year. They pay themselves, they pay their employees, they pay all their expenses. And let's say they have $50,000 net profit for the company at the end of the year. Well, we're going to take that number, that 50,000, and see how much debt, in monthly payments can that $50,000 support. So let's say, I use the example of the $100,000 business loan. Typically at today's rates, that's costing somebody about $2,200 to $2,500 a month in payment for 5 years. So literally I could take that $2,500 times 12. We're getting $30,000 a year in annual debt that has to be paid back every year for those 5 years. So is that $50,000 the business owner making enough to pay the $30,000 debt? Well, yes, it is. They'll have $20,000 left over.
But it's not part of their expenses, or you're on top of looking at their expenses, because you're looking at the expenses and then income, whatever the profit is.
Yep.
You're taking that, but then you're also going back to the expenses and saying these are the expenses to be able to cover for a year. Is that what you mean?
Yeah. Let's say we'll give you a $100,000 loan, and let's say the payments on that for a full year is $30,000, right? Or $2,500 a month. But I look at your 2024 tax returns and I see that you have net profit of $50,000. All I have to do is say, okay, $50,000 minus the new debt of $30,000. He's still going to have $20,000 left over. So there's enough to support it. In that. That's one way we can do it. That's more of a traditional kind of underwriting method. There's other programs where we can do it based upon the loan amount will be a percentage of your gross sales. There's other programs where, let's use the same example, you make $500,000 a year gross sales before any deductions, and I could say I can give you 10% of whatever your gross sales is as a loan. So if you're making $500,000, I'll take 10% of that. That's $50,000. and I could give you a loan for $50,000. You could even have, $1 net profit. You can have, $400,000 net profit. Doesn't matter. We're going to do it based on your gross sales. Those type of programs are great because they're very quick. They're easy to underwrite. Generally, you have to have pretty good credit. I'd say like 680, 700 is usually a good benchmark. But those are loans that can be done very quickly. They're smaller loans, but they're really great.
Like how much small? How small?
I mean, you could do them as small as like 25,000 up to like 250,000.
Oh, okay.
So you could do a decent amount, but you think if you're doing $250,000 loan, we're probably going to see gross sales of $2.5 million. So that's one way. But you can have a business that's doing $500,000, but maybe you have great, net profit. Well, we're not going to use that program because I could probably get you, a $250,000 loan. If you're bringing in $250,000 a year in net profit, that's way better than the company that's doing $2.5 million in annual sales but makes no profit. So it's all looking at, the financials of the company, how long they've been in business, what's their growth, the individual, the owner's credit score, and we can kind of figure out what program is going to make the most sense depending on what the objectives are of the business owner.
Okay. Wow. So we went from like purchasing real estate to like, how can I use this money to help me buy equipment and run my business out of this?
Exactly.
Okay.
Yep.
What about the rates? Are the rates like higher with some of these versus others, like the SBA loans or the conventional commercial?
So that's a good question. So SBA, the 7A program, as of today, they have a mandate that lenders are not and changes, so don't quote me on it, but based on the loan amount, typically they can't charge more than 2.75% over the Wall Street Journal prime rate. So, that will fluctuate whatever Wall Street Journal prime rate is. But those programs, lenders can choose how much they want to mark up the interest rate by. And, like I said, there's a lot of different lenders we work with. We work with banks, we work with credit unions, we work with non-bank SBA lenders. And typically, it all depends on the business owner, but you can get these 7A programs that can get more expensive. I've had ones where they were 10.5%, whereas banks were doing around 7.5%. But it was marked up higher because I've had business owners who wanted to start a business and buy the real estate, or I've had business owners that wanted to start a second location. So a great example is I had one client who had a restaurant in Providence, and they wanted to open up a second one because their first one was doing so great, but they wanted a second one. Now, most of the time, a lender will look at that as a new business you're starting, so there's higher risk associated with that. So what we did with that client, we took them to a non-bank lender for SBA lending, and we did 100% projection-based, what they believe, and they used the historical data for their first location to project what they thought they were going to make with this second location. And we were able to build out, for him 3 years projections based on his input and build his business plan, put it together. And we were able to get it to that non-bank SBA lender, and they were able to finance. This was about a $500,000 property in Providence.
Wow.
A smaller restaurant. It had the restaurant and it had a nice little, it was mixed use. It had a nice little rental property, a little 2-bedroom above on the second floor. And we were able to also project with that income that he would be able to pay the mortgage.
Very nice.
And he was able to get it done. Now, he did get a higher interest rate, but it was all based on projections. Nothing historical with this place. So because of that enhanced risk that was associated, he got priced higher. Now, if he had came back to me, let's say 2 years later, says, hey, Jeremy, I want to refinance this building. He has the historicals, he's going to be rewarded with a much lower interest rate. And he probably would have gotten, like today's rate's about 7.5% if he had done that. So there can be higher interest rates with the 7A program with SBA. It can also give you greater flexibility in the underwriting to help a business owner who wants to purchase the building. Whereas otherwise they would be out of luck and wouldn't be able to.
And there's some rules, like you said, like there's rules on like occupancy of the building that they're buying.
Absolutely. So I'll use that exact owner for example. So the restaurant, I think the whole building was like 3,000 square feet. So like I said, it wasn't huge, but the main restaurant was about 2,000 square feet on the first floor, and then the apartment above was about 1,000 square feet. One of the first questions I had to ask him was, how big is the residential part that you're going to be renting out? And the reason for that is there's strict rules by the SBA for, and and I'll finish this and I'll come back to non-SBA, but for SBA, the 7A program and the 504 program, SBA does not want business owners purchasing real estate for investment purposes. That's not the purpose of the program.
Okay.
So, but they will allow to have some of that mixed use, granted that the business owner's space, the unit count and the square footage, is more than half of the space that they're going to be using, that aside from what they'll be renting. So I usually say a good rule of thumb is that if 51% of the square footage is used for your business to operate it and run it, you can rent out the other 49% of the building, and that's perfectly allowed. It's only once we go the opposite way, SBA will not allow that.
It's kind of good that they can do that because, if you're looking at this price range for a building for your office and you're just limited to that price range that you can buy, but if you open up opportunities where you're looking at properties that have other rentals that you can get more income, now you can expand your, how much you can afford to buy.
Oh, yeah,
right?
Absolutely.
So that's a good thing for them. I mean, it's not like buying it to grow their real estate portfolio. It's
helps pay the mortgage.
Yeah.
I mean, a good example. I mean, a lot of the times, as we know, sometimes it is cheaper to rent than to buy. And, you may have business owners out there that are renting for $2,000 a month. It's a smaller space, but, that's why they're making that decision to get into a bigger space. And, at that point, they're considering, do I keep renting and now go to a bigger space and pay even more rent? Or do I finally own something? But maybe, the price range they're looking at, maybe the mortgage is going to be $4,000 a month, plus taxes, plus insurance. And they're like, that's a big bite to take. But having a little bit of that rental income can be something that can really help take some of that bite out of that big mortgage payment, because maybe they can get, $1,500 in rent. Maybe they get $2,000 in rent. And now when they do the calculations, they're like, oh, I can actually own this. And I'll pay a little bit more, a month, but my business is growing and I can do more capacity, more business, and that's going to well more than make up for it. And I have this safety net of this rental income to pay, because I could pay my $2,000 in rent right now. So it's a great opportunity for them to, if they find those kind of buildings, to do that. And it can be a residential rental. It could also be a commercial rental. So if they have, let's say, a 10,000 square foot, flex space, or retail space, if they're going to occupy 5,100 square feet of it, they can rent out the other 4,900 square feet of the commercial space. And that's perfectly allowed in SBA. And to circle back, for non-SBA, for just regular commercial bank lending, commercial mortgages, we don't care so much about how much you're going to rent out for that 51% of the square foot. So that's another alternative why everybody wouldn't say, oh, let's go SBA automatically. Well, that's one of the reasons. Maybe you find a building you don't need, in that 10,000 square foot example, maybe you don't need the 5,100 square feet. Maybe you only need 3,000 and you want to rent out the other 7,000 square feet. Well, this is a great option to not go SBA and get a regular commercial mortgage.
So I have a couple scenarios here. Okay. But first, let me talk about the conventional loan. If you're purchasing a building with the commercial loan for your business and you're occupying less than 50 or more than 50%, okay, it would be easy to go into an SBA. And they also wanted to purchase equipment or get money from the equity of the building. Is that possible? Could they do that? Like with a conventional loan, not SBA, 7A?
Oh, so just like do a cash out refinance of the building
Yeah, that they want to buy.
that they want to buy. So
I want to buy a
let's-
building,
yeah.
and I want to, it's a shoe factory,
Mm-hmm.
and so I want to buy it, and it has some equity because I'm buying it really a good price.
Okay.
Can I use some of that when I purchase it? Can I get some of that equity back so I can buy more equity with a conventional loan?
When you're first starting out and purchasing it.
Mm.
So typically for lenders, what they're going to look at is kind of like in the residential industry. You know, we could look at $1 million building, but if you're buying it for $700,000, the lender's going to base it on the lesser of the appraised value or the purchase price.
Okay.
So even though you may be getting, and I have one client with this right now, he has a multifamily and he got it at a really good price in Pawtucket, but he's owned it for only 7 months. So he's like, why can't I, it's inherently has so much equity in it. And unfortunately, he hasn't owned it long enough for the lender to use the new appraised value, the elevated value, because they're still stuck at it's what we call seasoning. So with that case, they would have to own it first. Typically a 1 year, I would say at minimum, of ownership. Then they would be able to then go back to the lender and do a cash out refinance to then take that money out and use it for whatever purposes.
But don't they want to make sure that the income will cover the additional? Okay.
Yeah, they'll still look at the owner's tax returns, make sure, do they make enough money to support this higher debt?
Because they might not be able to afford getting, paying all that equity. So they have to shave it down a little bit, right?
Correct.
Okay.
The only way that I could think of where you can kind of help out that inherent value is with a construction mortgage. Because at that point, we look at what we call the as-is value for how the building is set up today. And then let's say you have a construction budget of $250,000 and you're going to put that into the building. What would be the value of the building after that construction done? Or as what we call the as complete value, or for any people who are residential real estate or fix and flippers, what we call the after repair value is kind of the same idea that we look at for the commercial properties. So that's the only time that we can say, okay, maybe the building you're buying it for $700,000, but it's really worth $1 million. Then maybe we can kind of get some of that extra equity factored in for when it's complete. So that's one of the areas that you can maybe, you're still not going to be able to take cash out, but you can have, the higher value recognized by the lender because of that.
This is why you got Jeremy thinking creative and trying to make things happen for your, whatever goals you have. Okay, this scenario, this is another scenario. SBA loan, they want to buy this property. It's 3,500 square feet. 2,000 of the square foot is rented to someone, so they're going to get income from that. But 1,500 is where the owner is going to occupy, so that's less. But then they find 900 square feet somewhere, like the basement.
On the same, okay.
Yeah. Or another scenario where they want to build to make it match. Can they, how's that work? Which type of?
So they can go the non-SBA route, and that's going to be perfectly allowed because with the regular commercial mortgage, they're not going to care about the percentage. But if they're going to go the SBA route, the construction is one way to do that. Because if you're going to be adding that extra square foot and now it's pushing it over that 51% of the square foot, that's fine. You've met the requirement. So you can do that if you're going to be adding the square footage. Typically, they do look at, it's great you brought this up, another client where it's not exactly, they were an investor, but it was a mixed-use property, and it was 2 residential and 1 commercial, and it was in the basement. And this commercial tenant had like the whole basement for themselves. But they didn't really need all that space. So they acquired it. They told the commercial tenant, we want you to consolidate because you're getting cheap rent. They're like, you're using up all the space, but you could really consolidate this. So they made him consolidate the basement and shrunk his, I think he had like 1,500 square feet. He consolidated into like 750 square feet. And then they were able to get the other 750 and
put
rent
a wall.
They didn't even have to put the wall, but they just rented it to another business because they had almost like a walkout basement, so they had some entrance ways they can get in there.
Oh, okay.
And they did that.
Wow.
So But the reason I bring that up is because that's something else somebody can do. So let's say you do have a current business that has more than 51% of the square foot that you're renting it to. It's not a bad ask to say, hey, would that current tenant be willing to consolidate some of their square footage so that the new business owner can have the 51% of the square foot? So in this case, maybe they're occupying the basement space, right? And be like, well, I'm going to need the basement space for my business. You can always say, we want the basement space, and that may tip the scales for them to hit that 51% of the square footage for an SBA loan.
Wow.
So,
okay. So what about this? Like, what if they're buying a building, it has 2 spots or 3 spots to rent. The owner wants to occupy one. They're like less than 51%. But the second spot, that owner has another LLC that they're going to put there. Would that work? And they're the sole owner of both corporations or LLCs.
Well, I guess the question is, who's going to be the borrower in that case?
Oh, okay.
So that one's a little bit tricky. I know in the commercial non-SBA space, that shouldn't be an issue. Probably the lender would make both businesses guarantee the loan for the bank. They could do the same thing in the SBA because the SBA is just a guarantee, but as for the having one, because it's what you call like a non-arm's length transaction, because you have one owner owning both companies and everything. I guess the ultimate question is who's going to be the ultimate borrower on there, and then will that satisfy the SBA's 51% rule in that sense? That's one of those things where I'll have to dig it's what we call the standard operating procedures. It's a giant book that's all the policies and regulations for the SBA. That specific question will be have to more than dig through this giant encyclopedia to find the answer. But they have those answers because the SBA's gone through all of the different scenarios. So I'm not surprised that's going to be in there.
Things like that I think of, and like using ChatGPT, you just upload the whole thing, the PDF, and you're like, what about this scenario? What about this? What about this? How can I make this? It's amazing.
You're going to try to break the AI pretty much.
I want to see it sweat. That's what I want to do. I want to see it sweat. Wow.
Yeah.
Good stuff. So did we miss anything as far as, lending for real estate or anything that you wanted to mention?
No, I mean, we did a lot. I mean, like I said, there's a lot of flexibility. There's a lot of different structures on how to do your commercial mortgage or your business loan. I've had clients that do development. I have one guy, he does construction for like all the land and everything, all the site development. He got his bulldozers, his excavators, and that's all he does for a living. He just gets, digs out for people who need trenches or for septic tanks or leveling out. And, I did a loan for this gentleman in Massachusetts, and it was just literally, he had a pretty decent sized house with some land. He used, he had a garage there they used for his equipment, but he outgrew it. And so he bought a parcel of land that he wanted to do a steel building on. And of course, he was going to do all the site work, but we did a construction mortgage for him. Brand new building, wasn't even there. He had his site plans, he had his permits, he had his engineering plan, he had everything, his survey, everything for this lot. And we did the loan for him to help him purchase the lot. And then we gave him the construction mortgage for him to build his building. And we didn't do SBA for that particular one, but that's another option because commercial real estate, it can be very hard, as you know, to find the right building for a business owner. And sometimes development is an option for somebody to buy the land, and they can build a lot of equity doing that. There is a lot of costs and stuff with prepping land for that. But if somebody's willing to do that work and get it ready, we can get them the finance to actually construct the building that they actually want. So land purchase is another option. Traditionally, a lot of business owners, what they'll do is, because, land is cheaper than buying a building with the land, they'll buy the land first and go through that process to get it ready and permitted. And then they'll come to us to do the actual construction financing for them. So that's another option. And some developers, they'll do that. We've seen a lot of flex and warehouse space get constructed for the purpose of selling it. We've seen those like condo warehouses,
Yeah.
or tradesman bays that they sell. And there's people that do that and go through that process. And those all get funded through construction lending.
Interesting. Yeah, awesome stuff. This is really helpful, especially for our audience. So how do people find you?
Well, there's a couple of different ways. I got my website, which is benefitmortgageinc.com. They can reach me via email, jwhitlin@benefitmortgageinc.com, or you can always give me a call. And that's the easiest way.
Awesome.
So,
yeah.
absolutely.
Well, thank you very much for stopping by.
Thank you.
My agent's got a squad, we all in the zone. In-house help, so they ain't doing it alone. They focus on clients, negotiating win, while the back end's hand them, man, that's how we spin. I hand them business, watch them all climb.